welcome to SBI Mutual Fund presents Invest Smart Mutual Fund के Saath presented by ET Now. I am Kavita Thaplayal and today we are going to talk about debt mutual funds. Exactly. So we all know debt as a category is in a sweet spot and it's the right time for investors to make the best use of higher yields. But the big question over here that really lies is what kind of debt instrument are we talking about when you want to make the most out of these higher yields in terms of your returns, in terms of your portfolio allocation. And also, when we talk about fixed income instrument, are we also talking about fixed deposits and are debt mutual funds really better than fixed deposits? So we are going to focus on all the aspects of debt mutual funds today, and I have a fantastic panel who's going to deep dive on every aspect. Let's welcome on board Amit Gupta, EVP Head Institutional Sales, SBI Mutual Fund; Sandeep Sharma, EVP National Head Retail Sales, Alliances, SBI Mutual Fund; Harsh Rumta, Fee Only Investment Advisors. Hello and welcome all of you. First question to you, Amit. Clearly, we know that debt as a category has almost 16 type of debt mutual funds, which makes it a really reasonable kind of an affair for an investor in terms of their risk appetite, the kind of time horizon they are looking at. But let me just start with a very basic question, okay? Just for the investors to understand what exactly is a debt mutual fund.
Very right question, Kavita. This is something which we need to tell investor. As you mentioned, debt is something which is like a fixed income instrument where we are investing. Like equity mutual fund, where the investments are made into stock investments and all. In case of a debt mutual fund, the investments are debt into fixed coupon instruments.
Right.
These could be your government securities, your treasury bill, your corporate bond, commercial paper, certificate of deposit of different maturities. What it provides you is a lot of stability.
Right.
It also gives you a certainty in terms of the coupon you make. And as a part of asset allocation model, there has to be a certain investment which should go into fixed income kind of a debt funds. Now, where we are, trying to portray that to our investor is that when it comes to investing into mutual fund, generally we only speak about investing into equity mutual fund.
Exactly.
But there's a larger portion where we need stability, we need money for different kind of goals. There, debt mutual fund can play a very important role. We are strongly recommending that debt mutual fund should be an integral part for every investor portfolio, and the money is invested into top-notch companies.
Exactly. So, taking the answer that Amit just gave, Sandeep, help me understand. Are these debt mutual funds really good for all kind of investors? What me, as an investor, need to know before selecting the right kind of a debt mutual fund for myself?
Okay, so basically, as Amit also mentioned, there is a concept of asset allocation in any investment.
Right.
So when we talk about asset allocation, you cannot have a portfolio only of equity. You need to have debt. What debt does to your portfolio is that whenever there is volatility in markets, it ensures that the investor stays the course and he or she is able to realize the goals that they have set for when they are doing the investment.
Okay.
So I think one thing that you have to understand is that it is very important for each one of us to have some kind of a debt allocation.
Right.
Now basically, how do you really select? Mutual funds probably have made a mark as far as equity is concerned. Everyone knows about SIP, everyone knows about SIP book, but very less people know that mutual fund products are available for every person, for every reason, for every season. So you have an overnight fund where you can come in for one day. You have liquid fund, ultra short term funds where you can come for 1 month. You have savings fund, which basically are money market fund or low duration fund where you can be there for 3 to 9 months. You have short term funds for 1 to 3 years. So depending upon what kind of a need that you are having and when do you really need the product, you can very easily select a debt mutual fund.
All right. So as a thumb rule, I think we've established that one needs to have proper allocation to debt also in their portfolio, which is essential. But Harsh, why are we talking about it now? What has really happened? And I spoke about higher yields. Okay, how can investors actually can make use of it? How do I understand the kind of connection that debt fund and interest rates have?
So I think just two things, just going back a little. Okay, I think just to make sense of debt and equity, I think mutual funds somehow have become equity mutual funds. I invest in mutual funds essentially means I invest in equity mutual funds.
Yeah.
But just to make understanding clear, when you buy ownership stake in companies, when you become part owner, that's
Okay.
equity.
Okay.
When you lend to those same companies, that is debt.
Right.
So when you become a part owner, obviously as the value of the company grows, your value that you invested grows. If it falls, it falls. Whereas if when you lend to companies, the company promises to give you an interest, right? So you get that fixed interest and it promises to return the money. And if it is a good company, it will return the money. So I think, so that's debt. And I think so that brings a stability
Okay.
into this.
Okay.
Before I come to your yield question, I think two purposes are served by debt. One is basically for what shall you say, people who are investing to get the interest.
Okay.
Just get the interest. They need that interest for their day to day running.
Okay.
Right? So those are the investors typically who will put it into a fixed deposit where the interest is payable every month.
Okay.
Right? The second can be people who use it as a part of asset allocation. This much money I will put in debt, this much money I will put in equity. And when I say equity, it can mean international equity, it can also mean gold, etc. So, and for a balance, therefore, because equity goes up and down, it's very volatile, debt is not volatile, so therefore you need a balance. I think for both purposes, debt mutual funds are very, very good. Several advantages. One, I think, obviously because they are not guaranteed. In a bank fixed deposit, there is an implied guarantee. At least if it's bank, there is an implied guarantee.
Right.
In my book, I would say, do not, when you're doing debt, essentially, you are doing it for balancing. I would not recommend debt for increasing yield. You really want to increase your yield, okay? You go for slightly volatile instrument and increase their mix.
Okay.
Okay. So if you are able to take a little more risk, you take say 10% equity, 90% debt. You want a slightly higher return, keep increasing the percentage. And my logic is that do it in a self-balancing fund, auto rebalancing. Okay, I'm a big fan of auto rebalancing. The auto rebalancing takes care of the greed and fear cycle. Okay. Coming to the high yield, yes, currently they are high yield today. But like everything else for a retail investor trying to time it, I think it's full. I mean, you can see what has happened with timing, right? So the big guys don't get it right always. I don't think retail investors should try timing. Having said that, if you are the kind who's looking for an interest, maybe it's a good time to sort of take take a debt mutual fund.
All right. So, Amit, stability is guaranteed if you have a debt allocation in your portfolio. But now, the kind of yields you can lock in, and obviously, it's clearly established that if you want to go for a fixed deposit, just think about considering a debt mutual fund before that. Why? Though I will come to you for that later on. But then, talking about yields. Short term or long term, how should I plan this kind of an exposure looking at the yields right now? Short to medium would be a good play for me if at all I'm a person who's considering a lot of options in fixed income. So coming to debt mutual funds, should the ideal time horizon should be a short to medium, or I can also play a medium to long term considering the rising interest rates have almost peaked out.
So I will suggest, rather looking at short to medium or doing a comparison vis-a-vis long, it all depends upon the asset allocation model of the investor. That what kind of a time for which you are investing. See, at this point of time, Kavita, you mentioned yields are very, very attractive. The other point is the yield curve is totally flat, which means right from 1 year onward till 30 years, there is the same yield. Now, what we have been suggesting investor is to lock in such kind of attractive yield depending upon their time horizon. Now, in a country like India, where we don't have a defined pension kind of a strategies, for most of us at the private sector, we've been also suggesting investor to invest into as long as 40-year kind of a strategies. So the question is about the asset allocation. For what kind of a period are you able to part your money? And as Sandeep mentioned, even for a shorter term, you can keep your money into mutual fund just to balance it out. And as and when there is some bit of drawdown into equity, this debt allocation can be used to shore up the equity investment within the mutual fund portfolio allocation. So investment obviously long term, and there are lot many strategies being offered by mutual funds companies. So one can look at either active or passive. And for shorter term, you can be a part of any of the money market strategies, which again will give the similar return.
So, what kind of active and passive strategies in debt are we talking about? If you could just elaborate on that.
Yeah, so we have been talking about passive funds in equity, which basically mimic the underlying index.
Sure.
So similarly, in the mutual funds, we have launched passive debt funds.
Okay.
Now there is an underlying index which gets mimicked through the portfolio that we create. What it does is there is a defined maturity. So what it does is when he comes in, like in fixed deposit, there is an indicative return which comes to him, which he knows.
Okay.
Now we call it indicative because it is not assured and it can change depending upon the reinvestment that we do of the coupons.
Okay.
But it at least he knows that what he can expect from this fund. So these target maturity funds have become a rage. In last 1 year, almost 90,000 crore of inflows have happened in target maturity funds, over and above the money which has flowed into debt ETFs. So if collectively you see about 1.5 lakh crore has come into the industry. So these are the passive funds.
Okay.
But then like in equity, you cannot put everything in passive.
Yeah.
So if you really want to generate alpha on your investments, if you want fund manager to actively trade in and out of the securities in order to generate that alpha, you'll have to come into a active fund, active debt fund. Now in active debt funds, you have short-term funds, you have long-term funds. Right now probably we believe at SBI it's a good time to come into a gilt fund, where the underlying is government
Why
securities. So basically, if you really look at the 10-year government security today, it is giving you almost around 7.5%. And if you actively trade, so we have done some kind of a historical analysis in terms of in the previous cycles, what kind of a return we have been able to generate. So what we see is that we easily are able to beat a passive debt strategy at this point in time if somebody really chooses. So what we are suggesting our clients, our distributors, is that don't put all your eggs in one basket. Don't put everything in passive. Allocate judiciously, put something in passive, and definitely take some exposure into active debt also.
Okay. And so Harsh, how can you do it? SIP se hi hoga. That is what we say in equity mutual funds. So now can we say the same for debt mutual funds also, or a lump sum investment makes sense?
So if at all a lump sum investment makes sense, it's in debt mutual funds. I think, so I would never, the reason is that it does not, the prices don't go up or down as much. They do go up and down, but not as much as equity. So if at all a lump sum is indicated, it's in a debt mutual fund.
Okay.
But I just want to pick up on the point that Sandeep made about generating an alpha from active debt funds. So my own opinion always is that debt mutual funds for clients, at least that's what we recommend, and it can be different depending on the client's needs, but we recommend that any money you want to make over and above a market return, which means a passive return, I think that should be focused on more volatile assets, whether it is equity, whether it is international equity, whether it is gold, and if your portfolio is big enough, real estate.
So the intention is not beating inflation over here.
On debt, I think our recommendation is you use it as a balancing area, or even where you need that income on a regular basis. I think your first criteria has to be safety. It can't be to get higher returns. It's a point of view. I mean, I'm not disagreeing with what Sandeep says. It's just a point of view. And that's a point of view that we sort of express with our clients. Debt is not the right category where you want to get an alpha. I think that is the point. I think the question you asked
Or
was
how to invest, SIP or lump sum, which you
it should be
it should
lump sum.
lump sum.
It can be lump sum.
Okay.
It can be lump sum. So what are the risks in a debt mutual fund? There are two types of risks, right? We are lending to companies, or the mutual fund manager is lending to companies.
Sure.
So there are two risks. The company may not pay back.
Okay.
I think that kind of a risk should never be taken, is my point. So because you can get a higher yield because companies where the probability of repayment is little lower, right? AAA companies are the best, government is the best, AAA PSUs probably are next, AAA private companies are next, etc. etc. And as you go down the probability scale, obviously the interest you expect from those companies goes up.
Goes up.
Do you really want that increase in yield? My point is no. Again,
Okay.
it goes from the basic principle
Right.
that don't try exceeding, getting higher yield from debt. The other way you can get yield is by playing on duration, because when
Exactly.
yields
Yeah.
go up,
Hmm.
the bond prices drop, and reverse also happens. When yields will drop, when interest rate expectations drop, bond prices go up. Again, I think that is a game not for retail investors. I think so. Retail investors with debt is a good thing to play safe, and I think they should play safe.
Sandeep, let's focus on the portfolio construction now. Obviously, your risk appetite changes, as per the kind of income you earn and the age you are into. But then when we talk about having debt allocation, is there a thumb rule that one needs to follow? Like a 25-year-old will be able to take much more risk and much more allocation in equity than someone who's at 50. Okay. So how does that breakup actually play out? And also, how can one use debt investment instruments for the regular income post retirement?
Okay. So see, coming to your first question first, you're asking me to tell you that how can you really decide which fund you are going to invest in. Now, it all depends upon an individual. Now, it differs from individual to individual. Allocation also differs depending upon what are the need of the individual, what is the time horizon for which he wants to invest. Say, if somebody has a goal, like you said, emergency fund. Now, emergency fund is a must. I'm sure Mr. Rumta, that would be the first thing that he would be advising.
The first step of financial planning, must have an emergency fund.
So 3 to 6 months of your expenses you need to have in an emergency fund. You can use a liquid fund, you can use a overnight fund, and you can just be sure that if any contingency happens, you have some money with you. Then the next step is you would have certain short-term goals.
Okay.
Now maybe you want to go on a vacation after 1 year. Maybe you want to, after 2 years, you want to put in a lump sum money, buying into a house. You want to make that payment. You want to buy a new car. So these are all 1 to 3 year goals. Now here probably you have to go into short term funds only.
Exactly.
Because here you cannot really take that chance. And as when we come back to the asset allocation piece, any which way there are certain long term asset allocations that you do. Like when you have an equity exposure, you need to have some kind of a debt so that the volatility of equity gets evens out.
Okay.
So then you can probably look at funds which are long term in nature, and the gilt fund that we spoke about. We would like people to be there in this fund for 5-10 years, because ultimately underlying is government security. You are assured that government is not going to default in India, and therefore you have that comfort that today if you come into a government security fund, there is a coupon of about 7.5% that you're going to get, and you can stay put for a very long period of time.
So what one may also want to do is, when their goal is approaching, maybe just withdraw the money from equity and park it in debt. Can that strategy work?
Absolutely. So that is very essential. I think whenever we do financial planners like Mr. Rumta, I think this is very, very critical. As you are approaching, at the end of your goal, you have to move out of volatile asset into more stable asset, and that's what you do. You also use debt, like Amit mentioned, when you probably are finding equity markets to be very costly.
Okay.
And you don't want to allocate today. So you can stay put in debt. Like, the present time is a fantastic time when we are not very comfortable with equity because equity vis-a-vis debt appears to be costly. So therefore you stay put in short term.
Okay.
Whenever there is a market correction, you can move the money out of debt into equity.
All right. So it's not only about making the most out of this rising interest rate scenario, but it's more about giving stability to your portfolio and having the right asset allocation for yourself. Thank you so much for being on the
Thank
show
you.
today. And that will be all. Thank you so much for watching. Goodbye.